In Chapter 3, we will take a close look at the process of preparing adjusting journal entries at the end of the accounting period. Adjusting entries are necessary because not all transactions begin and end in one accounting period. For example, a customer may purchase inventory at the end of December and not pay for it until January of the next year. Toward the end of the chapter, we will review the preparation of our basic financial statements. The most common account period is 1 month. Companies also prepare interim statements during the year. When we divide business activities into arbitrary fixed periods of time, it is often necessary to have special accounting for transactions that cross from one time period to the next. Most of our time will be spent looking at the special adjusting process for some of these transactions. Here is a framework for adjusting the books of the company. There are 2 broad categories of adjustments. The first is when we pay or receive cash before the expense or revenue is recognized. This category includes prepaid or deferred expenses, including depreciation, and unearned or deferred revenues. The second major category of adjustments is when cash is paid or received after the expense or revenue is recognized. These are some very common adjustments. The category includes accrued expenses and accrued revenues. We will take a look at some common adjustments now. The first adjustment that we will review is for accrued wages. The following transaction occurred for Fanning Electronics. They use a calendar year as their annual reporting period. Part 1. Fanning Electronics pays its employees every Friday. This year-end falls on 12/31/08, which is a Monday. The employees will not be paid their wages until the normal payday of Friday, January 4th. The company's weekly payroll is $8,750. Compute the amount of the adjustment to be recorded on 12/31/08. Part 2. Here is a schematic of the dates. We need to record an adjusting entry on December 31st, 2008 to recognize the salaries earned by employees but not paid. Let's look at the adjusting entry. We need to accrue for 1/5 or $1,750 of wages due to employees for the 1 day of work that took place during the fiscal year ended 12/31/08. This amount is calculated by dividing the total weekly payroll for 5 days of $8,750 by 5. The daily amount equates to $1,750. Since 1 day fell within this fiscal year, we multiply the daily rate times 1. This amount must be accrued by Fanning to properly recognize the payroll expense in the period that it was incurred. We will review the journal entry for the payroll next. The 1 day of wages is accrued by increasing the wages expense, by debiting the account, and recognizing the amount due to the employees by crediting the liability account called wages payable. This adjustment increases the expense to properly record the expired cost in the proper period, which is for the year ended 12/31/08. Now let's move on to the depreciation adjustment. Plant assets, with the exception of land, are depreciated over their useful lives. Depreciation is the process of allocating the cost of a plant asset over its useful life in a systematic and rational manner. We are using straight-line depreciation. The calculation of the adjustment is equal to the cost of the asset less its salvage value. This amount, known as depreciable cost, is divided by the useful life. The result represents the amount of annual depreciation that must be recorded to show the loss of usefulness in the asset. For now, let's look at the adjusting entry to record depreciation expense. Part 1. On January 1st, 2007, Fanning purchased equipment for $20,000 cash. The equipment has an estimated useful life of 5 years and no estimated salvage value. Can you determine the annual depreciation expense for 2008? Part 2. How did you do? The numerator of the equation is $20,000, which is the cost less salvage value, and the denominator is 5, so our annual depreciation expense is $4,000. Now, let's record the adjusting journal entry. We have posted the adjusting entry to record depreciation expense. We have also shown you the balance in the equipment account. The depreciation expense account will appear on our income statement for the year ended December 31st, 2008. The accumulated depreciation account will appear on the balance sheet. Part 1. When accounting for deferred revenues, we are faced with a transaction where cash is received in advance of providing a product or service. In other words, we have received the cash but have done nothing to earn it. Part 2. When dealing with adjustments for deferred revenues, we always debit or reduce a liability account and credit or increase a revenue account. Let's review what happened with our company. On October 1, 2008, Fanning Electronics agreed to work on a new housing development. The company is paid $120,000 on October 1st in advance of future installments of similar systems in 24 new homes. The amount was credited to the unearned services revenue account. Between October 1st and December 31st, work on 20 homes was completed. Part 1. This is how the initial receipt of the $120,000 would be recorded. On the date of the receipt of funds, the company made a debit or increase to the cash account and a credit or increase to a liability account called unearned services revenue. We know the use of the word revenue may be a little confusing for now, but remember that the key word is unearned. The company has done nothing to earn the revenue. Part 2. Remember, the unearned revenue account is a liability and will remain a liability until the company account installs the alarm systems. Now, let's look at the adjusting entry the company will make on December 31st, the end of the accounting period. Part 1. As of December 31st, the company had completed the installation of 20 of the 24 alarm systems that they had received advance payment for earlier. Let's make the adjusting entry. Part 2. The adjusting entry is to debit or decrease the liability account, unearned services revenue, and credit or increase the services revenue account for $100,000. The amount is calculated by taking the amount of the original payment of $120,000 and dividing by the contractual number of alarms that the payment was for, which was 24 alarms. This means that the company will be earning $5,000 per alarm system, or $120,000 divided by 24. Since work was completed on 20 homes, the company will recognize $100,000, which is equivalent to the 20 completed homes multiplied by $5,000 each. Let's post the adjusting entry so we can look at the balances in the ledger account. Part 3. The unearned services revenue account has a credit balance of $20,000. This money will be recognized as more alarm systems are installed. The services revenue account has a credit balance of $100,000. The revenue account will appear on the income statement and be closed at the end of the accounting period. The liability account, unearned revenue, will appear on the balance sheet on December 31st. Now let's move on to the insurance adjustment. Part 1. On September 1st, 2008, Fanning Electronics paid $1,800 to pay for a one-year insurance policy. When Scott made the payment, it debited prepaid insurance and credited cash. Let's look at the adjusting entry we would make on December 31st, 2008. Part 2. We would debit or increase the insurance expense account for $600. This represents 4/12 of the policy since at year end, the months of September, October, November, and December have expired. We also credit or reduce the asset prepaid insurance. Now we have recorded the insurance expense for the months that have expired during 2008. Let's post the adjusting entry and see what the ledger account looks like on December 31st. Part 3. The prepaid insurance account is reduced from $1,800 down to $1,200. The insurance expense account now has a $600 balance. The amount of the insurance expired in 2008. Now we are ready to move on to an accrued revenue adjustment. Part 1. The adjusting entry to accrue revenues is needed because many firms may have delivered a product or provided a service but have not recorded the revenue in the current period. In our example, Fanning Electronics completed a $7,000 service contract on December 29, 2008. The service had not been billed for or recorded as of December 31, 2008. Part 2. In adjusting entries to record accrued revenue, we will always debit or increase an asset account and credit or increase a revenue account. Let's look at a specific example. Part 1. The company will debit or increase the asset accounts receivable and credit or increase the revenue account, services revenue for the $7,000 or the value of the unbilled amount. Let's look at the adjusted account balances. Notice that the accounts receivable and service revenue accounts have been updated to include the earned but unbilled amount of services provided. On the next slide, we have prepared a summary of the adjusting process. This summary will prove very useful when completing your homework or studying for the next exam. Here is how we read the table. Before we record a prepaid expense, the assets of the company are overstated and the expenses are understated in the current period. The proper adjusting entry is to debit or increase an expense account and credit or decrease an asset account. Take a few minutes to go over the remaining 3 types of adjusting entries before going to the next slide, where we will use a spreadsheet to prepare the adjusting entries and financial statements. The last step in the demonstration problem centers around the adjusting entries and their effects on the financial statements. Recall the following adjustments that have been discussed in the chapter. Review the table to understand the results of the adjustments. As a recap, the first adjustment, labeled letter A, was for the payroll accrual. Do you understand why net income was reduced by the amount of the adjustment? Letter B was the depreciation adjustment. Notice that its effect was also to reduce net income. On the other hand, letter C was related to a deferred revenue adjustment. By decreasing the liability account and increasing the revenue account, the net effect was to increase net income. Letter D was in regards to the insurance adjustment of the prepaid amount that had expired. This deferred expense reduced the amount of net income. And finally, letter E was an example of an accrued revenue. The result was to increase net income. Take one more look at the above items. It's one thing to memorize the debits and credits for the adjusting entries. It's another to understand the effects on the financial statements. Studying these adjustments will help sharpen your analytical and critical thinking abilities and help you in future chapters.